Indicators suggest that economic activity has continued to expand at a solid pace, the first sentence says, a carryover from December. Then a significantly shortened summary, quote, the unemployment rate has stabilized at a low level in recent months, and labor market conditions remain solid. Inflation remains somewhat elevated. Recognizing reality, the Fed did remove a reference to the, quote, inflation has made progress towards the committee's 2% objective, if you want to read a future policy clue perhaps into the statement. But that's it. The rest of the statement, other than the committee maintaining the target range at 4.25% to 4.5%, is unchanged. The central bankers say again that, quote, considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As they've said before, risks to the inflation and employment goals are roughly in balance. The committee continues QT, reducing the balance sheet at current levels, and does not mention any endpoint. And while 4 new members joined the rotation this year, Collins, Goolsbee, Musalam, and Schmid, the decision was unanimous. The rather anodyne statement puts the focus on Chair Jay Powell, who will be speaking to us in about half an hour. Other than acknowledging inflation hasn't made progress, there isn't much in here that will lead you to speculate on what they'll do next.
Mike, just stay right there. Just want to share the price action with you, then follow up with the question on the labor market. So equities have backed off just a touch, not a whole lot, but just a little bit more. We're down 0.6% on the S&P. Yields have kicked higher as well by a couple of extra basis points, at the front end by 5, on a 10-year now up by 4. The line on the labor market, Mike, it feels like they've buried the scare of the summer and that they're now satisfied, almost comfortable that unemployment can stabilize at these levels. And Mike, I'd wonder what you say about that.
At this point, it doesn't look like they're thinking that the labor market is going to rapidly decompose. There are some signs that things are getting a little bit slower. We're not seeing people get jobs as fast as they did before. But right now, unemployment is still low, and it moved down in the last month. So as long as that's the case, they're going to call it solid and not particularly worry about it. A real deterioration might lead them to cut, but they're not seeing that now.
Mike, looking forward to your questions in that news conference that kicks off in about 27 minutes' time. Bram, I don't know about you, but that jumped out for me. What led to this recalibration phase, if there was any urgency, it was off the back of the labour market data. That really set up that Jackson Hole speech for Chairman Powell. And it feels like they've put that to the back burner in the past.
Yeah, talking about labor market remaining solid and that unemployment has stabilized. You pair that with the other headline, which I think is important, which is removing the reference to inflation making progress toward the goal. You put those two things together on the margins, a bit hawkish, which is the reason why you're seeing the reaction in markets that you are.
A holding pattern for now, at least. Joining us, some of the best. The former Fed Vice Chair, Richard Clarida, alongside us, Bob Michael of JP Morgan. Rich, great to see you, as always, sir. Yeah. Your thoughts on this decision?
Well, as expected, you know, the chair wanted to buy some time in December. He accomplished that. As I think you indicated before, probably the interesting part of this will be the press conference and to maybe count the number of questions that don't involve the president or politicization. But I think the decision was well understood and I think justifiable given the data that you mentioned on the labor market and inflation.
What question, Rich, and I'm going to put you on the spot here.
Please do.
What would you ask, not related to Donald Trump, that you think he would actually answer in a press conference?
I'd like to get a sense from them on what it would take for them to start thinking seriously about doing a rate hike. You know, he's gotten a question along those lines at prior press conferences, and he's more or less said, that's not on the radar now, we're not thinking about that. Give him a chance to answer it again.
October 10, 1971.
I remember it well.
You remember that well.
Yeah.
Nixon and Arthur Burns, and we had the Nixon tape, so we know what happened.
Yeah.
There was a lot of political pressure on Chairman Burns at the time. In what way will Mr. Trump express his displeasure, and how should the Fed respond?
Well, I think the president will have opinions, as he's indicated, on policy. He'll share those. It's not going to have any effect on the decisions. You know, I was there for round one on that. And, you know, Jay Powell is not Arthur Burns.
Bob?
Yeah, you know, I took away the same thing that the market took away. Where was the dovish bias in this? And I think that's what the market was looking for. And they took out the labor market conditions had generally eased and put in solid. This does not sound like a Fed that's looking for the next opportunity to cut rates.
I think appropriate given the data flow. Remember, the SARM
100%.
rule had been triggered in September. It's now we've had good employment reports. Progress on inflation, which looked very encouraging in October, we've had several challenging months. And so I think this changes make sense.
Well, we talked about 71. Does this remind you of 95 when they only cut 75 basis points and everything was fine? And then they came back and hiked 25.
Well, and of course, in 2019 as well, the Powell Fed did 75 basis points, and I think would have stayed there but for the pandemic. So,
well, it's fascinating to see these headlines that largely were expected, but on the margins, a bit of a hawkish tilt, which is the reason why you're seeing a commensurate move in markets with yields marginally higher and stocks marginally selling off. I do wonder, though, Bob, you said earlier the idea that you don't want a rudderless central bank. How is this anything other than a rudderless central bank that's looking at the data in real time and susceptible to any shift?
They've acknowledged that they've done a good job. They've brought the economy to a reasonable soft landing. I think one of the questions that we have to hear Powell answer is, do they still view this level of rates as meaningfully restrictive? I don't think it is anymore. I don't think you can look at this data and call it meaningfully restrictive.
One of the joys of Columbia economics is the gentleman with the bright sport coat, Xavier Saleh Martin. He's expert on growth economics, international economics. There's a certitude here of tariffs. I don't buy it for a moment. I think there's huge ambiguity. Could our big surprise be a growth slowdown from any form, any magnitude of tariffs?
Oh, I think so. I think the scenario, I'm not hoping for, but what we saw in 2019 was the trade policy uncertainty was a headwind to the economy. Growth slowed, inflation fell, not only in the U.S., but globally. So you could see a scenario where in the end, we don't get a lot of tariffs. We don't actually get a lot of immigration, or at least relative to some of the concerns, but there's a lot of uncertainty about what the resolution is, and that can be a headwind to the economy. In theory, I'm not predicting it, but that's a scenario.
The run rate here on the economy, to me, is the key attribute right now. When you go back to Kasman and Feroli at JP Morgan, how do we get out to June? I mean, you got to view first half, second half like anyone appropriately should. But to me, there's this massive ambiguity slotting in April, May. How do you handle that?
Well, I think you have to look at what hiring looks like. And the quits rate has moderated quite a bit. You see employers out there hiring again. You also hear from our research analysts that businesses are investing more in CapEx. So it feels as though businesses have certainly absorbed the higher rates. It's also starting to feel like consumers have absorbed the higher rate regime. I think housing will be critical there. We'll see how housing does in the spring, but our expectation is it actually picks up from here.
Some aggressive pushback from Neil Datta of Renmac, who writes in and says the following: hawkish and complacent. Goes on to say the press statement makes clear that the dominating risk is a passive tightening of monetary policy. The Fed is remarkably complacent. I don't agree with their economic outlook. Housing is a mess. Wage growth is slowing. Core inflation is likely to ease in the months ahead as rental disinflation comes more into focus. Why do you disagree with that?
Well, I don't really disagree with any of that. All he's talking about is the economy continuing to glide to a soft landing. We've got inflation. We'll get core PCE in the next few days. That year over year is 2.8%. You could take the 3 and the 6 month, it's at 2.3, but it's not 2%. And Rich talked about tariffs in 2019. That was a much lower inflation regime. We were sub 2%. Yeah. Now we're over 2%. So I think the Fed would like to keep rates here until they see inflation actually down at 2%.
Let me put something on the table. We could get some good news on inflation for 3 or 4 months. The year-over-year comps will actually be favorable to those calculations. We could be looking in April at inflation running in the low 2s, and then the question will be, why aren't you cutting? So again, 3 and 4 months of data can change sentiment and potentially the Fed's outlook pretty notably, I think.
You both asked great questions, or gave journalists good questions to ask. You were asking what would it take to hike rates, put that back on the table. And Bob, you asked, are rates meaningfully restrictive because you don't think that the evidence points to them being so. Rich, would you agree that based on the economic data, it is hard to say that rates are meaningfully restrictive, despite what you're seeing in the housing market and despite the normalizing that you can see in some pockets as potentially weakness?
Well, certainly rates are less restrictive than they were. I judge that they still are restrictive. What I would say, however, is part of the reason financial conditions appear pretty supportive is markets continue to price in rate cuts. In a scenario where the Fed probably says, we are really done, financial conditions won't look as accommodative as they do now. So part of the financial conditions story is continued cutting. And as Bob said, the soft landing. And you could have a Powell Fed saying, we want the soft landing, but no more rate cuts. That would change financial conditions.
I'm going to say something that might be somewhat unpopular around this table. I would sense, and I think a lot of people watching might feel the same and listening too, that this is convenient framing to insulate themselves from political criticism. That back in December, Chairman Powell made such a hash of it in the news conference and invited criticism about whether they were anticipating policy changes and whether it was the incoming Trump administration that changed their stance. And now they get to put out a statement that says, no, this is about elevated inflation and a solid labor market. How much has changed in the last 5-6 weeks? Has that much changed in the last 5-6 weeks? Why didn't they make this argument back in December? Is this about policy or is it about the data?
Well, maybe we will find out in the press conference when someone asks Fed Chair Jay Powell just that. I will say it seems like it's going to be an increasingly politically delicate situation for Jay Powell. I'm curious to see whether he just answers, I'm saying.
This is one way of insulating the committee from that criticism. You can just point to the statement and say it's about inflation, it's about the data, and we're not talking about policy.
Well, and at some levels, some of the members probably feel that way. Question is who, right? Are there people who are factoring certain things into their views? I will say that the flipping and the flopping, there should be at some point an anatomy of what happened in all of this time to really understand exactly what the deliberative process is at the Federal Reserve.
Rich can tell us what he really thinks in a commercial break that starts in about an hour's time after that news conference is finished. Do you want to share it now?
Well, as I said, they made the judgment in September. The labor market was softening. The Somme rule had been triggered. They had good. It's no more complex than it is data dependent. And in particular, they were disappointed that there was not more progress in inflation. You are completely right, Lisa, that the comments on, is there a placeholder, is the staff forecasting, what do people factor in? We now know from the minutes that, in fact, the placeholder was in the staff forecast in many of the participants. And so, that's another consideration as well. I'm sure he'll be asked that.
If you are just joining us, welcome to the program. Equities declining by 0.8%. This was meant to be a non-event, turning out to be somewhat of an event. Rates unchanged, but with a hawkish bias in the statement. Bond yields are a little bit higher off the back of it as well. If you check out the 2-year, 10-year and 30-year going into this decision and the release of the statement, yields were higher by a couple of basis points, now up by 5 on a 10-year to 4.58. Diane Swank of KPMG joins us now for more. Diane, welcome to the program. Your early reaction to that statement, please.
Well, it is a little bit hawkish, and I do think it's well expected. I agree with Rich that this is in response to the data. We got a better employment report than expected at the end of the year. That is factored into the statement with the solid. We've also seen that inflation, the path down is much slower than the path up, and the last mile has looked a little sticky. I also agree with Rich, though, that we could get some very good inflation data in the first 3 months of the year, January, February, and March. And that will be interesting because not only is it the year-on-year comps, but they're changing the seasonal adjustment to the personal consumption expenditure index, which the Fed targets. That's important. What the Fed can't do is they can't front run policy. There are policies that people fear are inflationary: tariffs, mass deportations, and tax cuts. On the flip side, there's policies they see as disinflationary: deregulation and cuts in government spending. And until we know the sequence of policy, the magnitude of policy, the Fed can't front run that, even though they're doing simulations on it. And the magnitude is different today than it was in 2018 or 2019. I think the other important issue is that the embers of inflation are still burning. This is not a situation where they've already defeated inflation. So it makes sense, again, behind the data. I think they'd like to be more forecast oriented in their policy setting, but I don't know how they can be, because one, we don't know the sequence of those policies, and two, it's important that the U.S. economy has humbled the Fed more than once.
Jason, or rather, Diane, you stopped me cold today with a Jason Furman chart going back to the 30s, the analog back to Smoot-Hawley as well. And there's a lot of other noise going on as well. But the answer is the unspoken here is disinflation, and not the fear of outright deflation, but just the slowing of the economy, which gets you, frankly, to a Bob Michael lower yield environment. Discuss the analog you have back to the 30s and tariffs, as you showed in the Furman chart today.
Well, you know, Jason had put that out there a long time ago. It was really important was that we had a major tax hike in the form of tariffs, the Smoot-Hawley Tariff Act of 1930, after we were into the Great Depression, which tipped off a trade war with 25 countries and a 67% collapse in global trade. And that was important because it added insult to injury and pushed us further into the depths of the Great Depression globally and helped to sow the seeds of World War II. So that was very important. It was already in the context of an environment where disinflation and deflation was occurring. That is not the case today. And that's why, you know, but we don't know. There's still a lot of uncertainty, as Rich pointed out, about which policies happen first, you know, which is more weakening, which is more inflationary, or what is the one thing we've not talked about, what's stagflationary out there. That is a possibility. And I think that's important too. And the Fed is looking at this saying, listen, we're looking at the data. We got the data in the last 5 weeks. We've gotten data that justify that statement, and that's it. Period. Full stop. Wait and see.
I want to bring you into this because there is a question around scenario analysis and how this Federal Reserve is going to analyze the ramifications of tariffs at a time that otherwise is somewhat inflationary. What would you say to that? Do you have a sense of what that scenario analysis looks like?
Well, they're probably looking at more than one, and they have to factor in retaliation, no retaliation. They have to factor in how much does the dollar adjust. They have to factor in how much do U.S. companies piggyback off the tariff for domestic companies to hike. So if I were there, I'd probably say they might be looking at 4 or 5 different scenarios, and then in the end, you sort of put a weight on them to give you your forecast. I don't think they're at that. My sense is they're probably not at that point yet in terms of detailed probabilities on each, but they're starting to go down that road, I think.
The Fed is in the best position it's been for 20 years. Think of it this way. If something goes wrong with policy, either rates are too restrictive for too long, or something comes out of the administration that causes the downside and unemployment goes up a lot, they can cut rates a couple hundred basis points from here. They've got plenty of room to do that. If the other happens, and actually there's a reacceleration in growth. We're in too much of a pro-growth mode, the golden age of America, and inflation starts to tick up. They can hike rates 100 basis points or so. It's been a long time since the Fed has had that capability to react in either direction.
Dan Swank, I want to give you the final word just on that conversation. Bob Michael says it's the best position this Fed's been in 20 years. Do you agree?
No, that's an easy answer, but this is a very hard situation for the Fed because they can't be preemptive. They can't forecast it because they've got to wait for policy and react to it. And then they've got to figure out the one scenario that's not in there is a stagflationary scenario, which I don't think we get to unless we have a really big policy mistake until 26, 27. And one would hope that we'd see a course correction before then. But that is one of the scenarios you have to put into this equation. And that other issue on the expectation of inflation, both in terms of consumers expecting it now with a muscle memory that they didn't have before, the willingness to buy ahead of tariffs. Once they see tariffs out there, that is a different situation than we had in the 2010s. And the fact that companies have already raised prices through this cycle where we didn't have that in the 2010s. No one even thought of raising prices except for the things that were tariffed, which were passed on or bought with them, like dryers with washing machines. So I think we really have to look at this as a very different scenario. And to me, it doesn't feel like the easiest place at all for the Fed. It's one of the harder positions for the Federal Reserve to be in.
Dan, I think that's probably the difference between economists and market participants right now, explaining that one. Dan Swank there of KPMG. Matt Lazzetti of Deutsche Bank is an economist, and Matt Lazzetti joins us now for more. Matt, you came out last year, one of the first to do so, and said no rate cuts in 2025. Do you think the statement today, this afternoon, sets us up for that?
Well, I think the statement moves in that direction. It's a mark-to-market of the data that we've seen since the December FOMC meeting, and I think it acknowledges that the Fed is feeling a bit better about the labor market, the downside risks they were worried about there last year, they're not completely gone, but they've diminished, and that we've seen kind of a lack of progress on inflation over the past several months. But the reality, and as part of this discussion, we're going to see big changes in data flow over Q1 and over the coming quarters, and we have a lot of policy risks that are out there, especially from the Trump administration. So while it does lean in that direction, reduces the probability of near-term rate cuts, I think the Fed will have to see how these policies shake out to really know how policy is going to adjust over the course of the year.
This is wonderful. The Fed decides. Matt Lazzetti, Bob Michael, and Professor Clarida. Professor, I'm going to go to you on this.
Yes, sir.
This afternoon, maybe more important than the economics, is Microsoft and Facebook with a combined $110 billion of free cash flow in the last 24 months. We have a part of America absolutely booming, technology, productivity, you know the drill. And we got another part of the country, as Craig Torres writes about for Bloomberg, flat on their back. How does Powell handle that with this new president, this bipolar America?
Well, I think it's been an emerging fact of life in the U.S. economy for decades. The numbers I like to look at are, 2/3 of Americans own their own home. That means a third don't. More than half of Americans own stocks. I mean, the other half don't. So if you own your house, you have stocks, you've had a really good run. If you don't, it seems like a very, very tough time. And so the Fed can only really impact aggregate employment and output. And so I don't think there's a lot the Fed can do about it, but it creates a challenge in terms of navigating sentiment for sure.
Well, Matt, just to go to you on this, we were talking about whether the Fed is in a really good position, as Bob Michael was saying, or whether, as Diane Swank said, a really uncomfortable position because they're stuck between a rock and a hard place in terms of what their effect, to Rich's point, is on the overall economy versus markets and how much they really are potentially facing off risks that they can't counter. Do you think that the risks are skewed higher to them missing an inflationary boom and not getting ahead of it, or to allowing the economy to deteriorate more rapidly by not cutting rates sooner?
Yeah, look, I think that they're well positioned at the moment. They did their 100 basis point recalibration. I think that was the appropriate step to take over the past year. At the same time, growth is strong, the labor market's resilient, and there's really no need for them to cut rates further from here. So I do think that they are well positioned. I would agree with Bob that it's a good place to be in because they have a lot of scope to cut rates if they need to. They can also re-hike rates if they have to at some point, although that will be, I think, highly disruptive to markets. At the same time, the policy risks that they're facing from tariffs and immigration and fiscal policies are immense here. And so I think specifically for today, probably March and maybe even a little bit further, it makes sense for them to take a step back. There's no real need to take a policy action in either direction at this point in time, and to see how those uncertainties kind of get resolved over the coming months. The only thing that I would also mention, as we look ahead, even if inflation comes down to call it 2.25% or so, what is the reason to be cutting rates if the labor market is strong and growth is resilient and financial conditions are easy? So that's part of our view for why we see the Fed on hold this year.
Matt, for people who aren't familiar with your complete outlook for 25 and beyond, can you just share with us your view for real GDP, for unemployment, and your working assumptions around policy from the Trump administration and how they influence or not your outlook?
Yeah, so for this year, we expect a continuation of sturdy growth. We have 2.5% real GDP growth for this year, basically a continuation of what we are likely to have seen in 2024. The labor market, we expect to retighten just a modest amount from here to 3.9 or 4% on the unemployment rate by the end of the year. That looked optimistic a few months ago, but I think it's much more in line with the data. And we also expect that core PCE inflation remains at 2.5% or above this year, which is also what the Fed anticipates. Now, we do have tariff effects built in there. Tariffs add 0.2% to our core PCE inflation forecast this year, but we don't have a universal baseline tariff, and we don't have 25% tariffs on Canada or Mexico built in. We're going to learn a bit more of that over the course of this weekend, and those are upside risks to our inflation forecast.
That's just how much the outlook could change after the weekend. Matt, appreciate it, sir. Matt Lazzetti there of Deutsche Bank, going into this news conference with Chairman Powell. Again, if you are just joining us on Bloomberg TV and on Bloomberg Radio, the decision coming from the Federal Reserve just 24 minutes ago, rates unchanged, but in the statement, most economists and most strategists look at that statement and assume there's a bit of a hawkish tilt, a hawkish bias in that relative to what that statement looked like last time around. So off the back of that, equities lower, near session lows on the S&P were down by 0.8%. Similar move on the Nasdaq. In the bond market, Lisa, yields are up about 2 basis points going into this decision. Coming out the other side, we're up about 5.
So not a massive move. Still, people taking note that this is a labor market that is, quote, solid, not necessarily weakening to some sort of degree, and that inflation risks still are present. There's not as much progress made. In the press conference, I really am actually curious about the two questions we heard from our panel. I think that they are very important questions. Number one, what would it take to hike rates at a time where potentially you could end up with that really disrupting markets? And then are rates meaningfully restrictive at a time when the economy is really doing quite well?
Bob, do you think they are meaningfully restrictive?
I think they're slightly restrictive, and that's why inflation will continue to come down. But meaningfully, no chance.
Are they all on the same page? Is there dissent there that's not unrecorded in a Greenspan-like way?
Well, we'll find out in 5 years when the transcripts come out.
Good. Can't wait.
My sense is that there probably is, a very wide range of views right now on the committee, probably more about the scenarios than the current position. I don't think anybody was secretly wanting to do anything today other than hold. But I do think of a committee with different backgrounds and perspectives. And I think as they start to drill down, as Lisa said, on specific scenarios as opposed to placeholders, it could be a very lively set of internal discussions.
This goes back to the Ben Steele essay today in Barron's. I mean, the scenarios, as you mentioned to begin with, the data dependency is everything.
Tom, why can't you find out in the next couple of weeks? Invite them on. Ask them these questions. Ask them if they model.
I had Krugman on it, okay, and he was heated about the dynamics of tariffs and the ambiguity, the uncertainty that's out there in the dynamics of tariffs. We don't have, what are we going to do with a 25% tariff on, name a country, John?
Canada.
And Gura talked to Christian Friedland, right? What does that mean at Columbia with a piece of chalk in your hand? To see that 25%?
Well, yes, you would notice it. I think the challenge for markets, so I really have this sense that part of the financial conditions story right now is that the more outrageous is the headline number, the least likely it is to actually stay in place for very long. I think most people think of this tariffs as being more of a bargaining chip than a battering ram. But again, uncertainty, but I think that's my take on it right now.
Is there an economic drag, Bob, from the policy uncertainty? Is that something that you already can take into account?
It doesn't feel like it. It feels like there's no obstacle to accessing capital. We see businesses out there acquiring capital and doing things with it. You just look at the size of the private credit market. We've gone an hour. We haven't mentioned that. There you go. It's closing in on $2 trillion. There is an underlying vibrancy to the economy, which I think will surface over the next couple quarters.
One of the confidence aspects that people keep coming back to is that markets act as the ultimate check on this president, on the ultimate check of this Fed, because they're looking at a lot of the data, and an ultimate check on exactly what is permissible and what isn't. How much, Rich, do you think that, frankly, the Fed is comforted by the strength and the resilience in equity markets and with the bond market where it is?
Mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong, is strong overall, and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.6% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews. Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. I would note that the committee's 2% longer run inflation goal will be retained and will not be a focus of the review. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer run inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Mr. Chairman, Steve Leisman from CNBC. Mr. Chairman, at a event in Davos, or to Davos anyway, the president said he'll demand that interest rates drop immediately. So I guess I have a 3-part question. Has the president done this to you? Has he made that demand? Secondly, what is your response to that? And third, what effect, if anything, if any, does a president making these kind of remarks have on policy? Thank you.
3 questions. I'm seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have focusing on using our tools to achieve our goals, and really keeping our heads down and doing our work, and that's how we best serve the public.
Can you just comment on whether he's physically communicated this demand to you?
I've had no contact.
Thank you.
Thanks.
Nick Timmeros, The Wall Street Journal. Chair Powell, you and several of your colleagues said around the time of the last meeting that your policy stance was meaningfully restrictive. Given economic and financial market developments since then, how has your confidence changed in an assessment that says interest rates are meaningfully restrictive?
I don't think that my assessment really has changed. I mean, a couple of things have happened. We've gotten more strong data, but we've also seen rates move up at the long end, which could represent a tightening in financial conditions. I think if we look back over the past year or so, we can see that policy is restrictive. If you look at the effect of high rates on interest-sensitive spending, for example, in housing, and if you look at the achievement of our goal variables, we're seeing the economy move toward 2% inflation and has moved largely to maximum employment. So we really look at movement toward the goal variables to make that assessment. Now, policy is meaningfully less restrictive than it was before we began to cut. It's 100 basis points less restrictive, and for that reason, we're going to be focusing on seeing real progress on inflation, or alternatively some weakness in the labor market before we consider making adjustments.
If I could follow up, does the economy here warrant meaningfully restrictive interest rates? And would you judge interest rates to still be meaningfully restrictive if you were to lower them by another quarter point?
So I think our policy stance is very well calibrated, as I mentioned, to balance the achievement of our two goals. We want policy to be restrictive enough to continue to foster further progress toward a 2% inflation goal. At the same time, we don't need to see further weakening in the labor market to achieve that goal. And that's kind of what we've been getting. The labor market has really been broadly stable. The unemployment rate has been broadly stable now for 6 months. Conditions seem to be broadly in balance. And I'd say you look at the last couple of inflation readings and you see we don't overreact to two good readings or two bad readings, but nonetheless, the last couple of readings have suggested more positive readings. So I think policy is well positioned.
Colby from the New York Times.
Colby Smith with the New York Times. Chair Powell, how should we interpret the removal of the line from the statement that inflation has made progress towards the 2% goal? Is that no longer the case?
No. So let me look. If you just look at the first paragraph, we did a little bit of language cleanup there. We took out a reference to since earlier in the year as it related to the labor market. And we just chose to shorten that sentence. Again, I mean, if you look at the sort of intermeeting data, it was good, and there was another inflation reading, I guess, just before the December meeting. So we've got two good readings in a row that are consistent with 2% inflation. Again, we're not going to overinterpret two good or two bad readings, but this was not meant to send a signal. Other than this, you can take away from all of this that we remain committed to achieving our 2% inflation goal sustainably.
And just to follow up, we've seen inflation expectations across a number of measures rise sharply, which has in part been linked to tariff concerns. But there's also been this encouraging data that you mentioned in terms of CPI and rent indices. So how would you characterize concerns about upside risks to inflation across the committee, especially those tied to policies related to the Trump administration?
Well, I'd say you see expectations moving up a little bit at the short end, but not at the longer end, where it really matters. And those could be related to what you mentioned, some of the new policies. I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We're only just beginning to see, actually are not really beginning to see much. And I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So we're going to be watching carefully. And as we always do, this is no different than any other set of policy changes at the beginning of an administration. We'll patiently watch and understand and kind of not be in a hurry to get to a place of understanding what our policy response should be until we see how it plays out.
Michael McKee.
Michael McKee from Bloomberg Television and Radio. You and your colleagues normally condition future policy moves with the phrase, if the economy develops as we anticipate. Is it fair to say that since there's a lot unknown about what this administration's fiscal policies are actually going to be, that you don't have a medium to long-term economic forecast that you can have confidence in? Or if that's not true, can you lay out what you think is going to happen in the economy, how you see it developing?
Well, at all times, forecasts are conditional at a minimum on just a set of expectations, and they're highly uncertain in both directions. We know that economic forecasting is really difficult beyond just a month or two out. So in the current situation, there's probably some elevated uncertainty because of significant policy shifts in those four areas that I mentioned: tariffs, immigration, fiscal policy, and regulatory policy. So there's probably some additional uncertainty, but that should be passing. We should go through that, and then we'll be back to the regular amount of uncertainty. So, what forecasters are doing, not just us, but everybody's doing, is they've got sort of just a set of assumptions about what might happen, but they're really kind of in the nature of a placeholder. And meaning, plausible could be, but honestly, you wouldn't stand behind it because you just don't know. And so you're just on hold, waiting to see what comes down. It's a very large economy, and policy is affected at the margin. But we're going to wait and see.
If I can follow up, the idea that you feel the economy that policy is restrictive suggests that the Fed in general wants to continue to lower interest rates. So when you look at the data that you are dependent on, are you looking for data that tell you that you can cut, or data that will tell you you should hold?
We're looking. It's more the other. The way it works is we are looking at the data to guide us in what we should do. And, that's what we do. And right now, we feel like we're in a very good place. Policy is well positioned. The economy is in quite a good place, actually, as well. And what we do expect is to see further progress on inflation. And, as I mentioned, as we see that, or if we were to see weakening in the labor market, that could foster, we could then be in a position of making further adjustments. But right now, we don't see that, and we see things as in a really good place for policy and for the economy. And so we feel like we don't need to be in a hurry to make any adjustments.
Howard.
Howard Schneider with Reuters. Thank you very much. In 2021 at a central bank conference, you said, quote, throughout my career in both public and private sectors, I've seen that the best and most successful organizations are often the ones that have a strong and persistent commitment to diversity and inclusion. These organizations consistently attract the best talent by investing in and retaining a world-class workforce. First question is, do you still believe that? And if so, how do you intend to put that belief into practice while remaining consistent with the recent executive order prohibiting diversity and inclusion efforts?
So let me say yes in answer to your first question, but to the second question, I want to say this. We are, like others, we're reviewing the orders and the associated details as they're made available. And as has been our practice over many administrations, we are working to align our policies with the executive orders as appropriate and consistent with applicable law. And I want to add that I'm not going to have anything more specific for you today on this whole set of issues.
Well, if I could just follow up quickly on that, I'm wondering how you're getting that to be consistent with the Dodd-Frank law's stipulations about maintaining an Office of Minority and Women's Inclusion.
So I did mention consistent with applicable law, all right?
Which is governing.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. Just to follow up on Steve's question, what reassurance can you give the American public that the Fed will continue to operate independent of politics under this administration?
As I've said countless times over the years, this is who we are. This is what we do. We study the data. We analyze how it will affect the outlook and the balance of risks, and we use our tools to try to given our best understanding, our best thinking, try to achieve our goals. That's what we do. That's always what we do. Don't look for us to do anything else. And that's, lots of research shows that's the best way for a central bank to operate. That'll give us the best possible chance to achieve these goals for the benefit of the American people. That's always what we're going to do, and people should have confidence in that, as I said a few minutes ago.
You've said that the Fed is in wait-and-see mode based on the policies that come out of this administration. Has the Fed started to model what policies like mass deportations, changes in immigration policy specifically, would look like for the workforce and for inflation?
So one of the things our staff does is they look at a range of possible outcomes, and they tend to go from really good to really bad, and it's one of the best things that they do. And in each teal book, you can look at the 5-year-old teal books and see their alternative simulations. So that's what they do. There'll be a baseline, and then they'll show 6 or 7 alternative scenarios, including really good ones and not so good ones. And what those do is they spark the policymakers to sort of think and understand about the uncertainties that surround this. So yes, the staff does that, and we're all well aware that the range of possibilities is always broad, and not just now, but always. And it's hard to be open to just how broad the possibilities are for an economy. No one saw the pandemic coming, and it changed everything. So things happen, and but yes, we do that. But it's different. It's one thing to do that, to make assessments about what might happen and begin to think about what you might do in that case, but you don't act until you see much more than we see now.
Katerina Saraiva, Bloomberg News. Last month you talked about a future rate cut as being pretty, significantly predicated on more progress in inflation. With the characterization of the labor market in the statement today, would you say that that's even more so the case now?
I'd say it's the same. We want to see, further progress on inflation. And, the story's there. We're just going to have to see the data. At the end of the day, it comes down to 12-month inflation, because that takes out the seasonality issues that may exist. And, we're just going to need to see that. We think we see the pathway for that to happen. One example, a key example, is that you now do see owner's equivalent rent and housing services, the way it's calculated for PCE. You see that coming down pretty steadily now, and that's the place where most of the remaining gap is. In addition, a big part of the overrun, as you will know, was from non-market services, which don't tend to send much signal. So you can look through all that and think, okay, then we seem to be set up for further progress. But being seen to set up for it is one thing. Having it, we're going to want to see further progress on inflation. But remember, we're not, we're under 2%, but our goal is 2%, and we do mean to get back sustainably to 2%.
And in terms of the labor market, I mean, how is that broadly? You said a broad set of indicators show that it's in pretty solid place. Was there broad agreement on that? There's been a few underlying indicators that are showing perhaps some weakness, a low hiring rate, workers reporting that it's increasingly difficult to find a job. Is that of concern to the committee?
So you're right. I mean, we look at, of course, a very broad range. So it starts with unemployment, with the unemployment rate, employment participation, wages, job quits, are people quitting, that kind of thing. The ratio of vacancies to unemployed. We look at all those things, and you put your finger though on it's a low hiring environment. So if you have a job, it's all good. But if you have to find a job, the job finding rate, the hiring rates have come down, and that's more typical of a. Let's say that the unemployment, that the labor market is at a sustainable level. It's not overheated anymore. We don't think we need it to cool off anymore. We do watch it extremely carefully. It's one of our 2 goal variables. But I'd say we watch those things quite carefully. But nonetheless, overall, look at the aggregate data in the labor market. The labor market does seem to be pretty stable and broadly in balance when you've got an unemployment rate that has been pretty stable now for a full half a year.
Edward. Thank Thank you. Thank you, Mr. Chairman. Edward Lawrence with Fox Business. On employment, now you said there's a broad range of possibilities, but last September you said, quote, "We understand that there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise." Now that the flow of the border has slowed and we're seeing deportations, how do you expect the unemployment rate to react?
So what's happening is that the flows across the border have decreased very significantly, and there's every reason to expect that to continue. But job creation has come down a bit too. So, if those two things come down together, that sort of can be a reason for the unemployment rate to stabilize. In other words, the break-even rate, as population growth slows, the break-even rate that you need in new jobs to make make jobs for workers declines as well. So that seems to be something about what's happening. You do see a very flat unemployment rate at a time when you've seen significant declines.
I want to ask you about Fed employment. I know that tax money is not used here, but Elon Musk alleges that the Fed is, quote, absurdly overstaffed. We've seen the executive branch push to reduce the federal workforce. I just want to get your reaction.
We run a very careful budget process. We're fully aware that we owe that to the public, and we believe we do that. I've got no further comment than that. Thanks.
Chris.
Chris Rugaber at Associated Press. President Trump has said he will lower inflation by reducing gas and energy costs. Do you see such costs as a particular driver of inflation, and would lowering them have a dramatic effect?
Chris, I'm not going to react or discuss anything that any elected politician might say. So I'll give you a mulligan.
Okay, thank you. Well, nearly 2 weeks ago, the Fed said it was withdrawing from the network for greening the financial system, even as we have significant wildfires in Los Angeles doing billions of dollars in damage. And of course, the NGFS, as you know, is a group to talk about how the financial system could address climate change. Many commentators did see the timing as political. Why did you leave that organization? Can you explain that decision?
Sure, I'd be glad to. So we considered this, really at length, and we did decide to withdraw from the NGFS. And really the reason is that the work that the NGFS does has broadened very significantly. Think about nature-related risks and biodiversity and things like that. In addition, the work of the NGFS is in significant part intended to, and this is a quote, mobilize mainstream finance to support the transition toward a sustainable economy. So we joined to get the benefit of understanding what other central banks were doing and seeing research and things like that. I think this is just way beyond any plausible mandate that you could attribute to the Fed. And so we have a quite narrow role, as I've said many times. And I think that the activities of the NGFS are not a good fit for the Fed, given our current mandate and authority. So, and I just think it was time to acknowledge that, this process dates back a couple of years. I made the decision to bring this to the board, some months ago. The process just took time to get here, and this is when we got it and voted on it. So, and I'm aware of how it can look, but it was really not driven by politics. It was driven by kind of the disconnect between the work of the NGFS and our mandate. Other central banks have different mandates and belong to the NGFS. We have no criticism of them, but it just isn't. It's not right for the Fed.
Andrew.
Thanks, Andrew Ackerman with the Washington Post. I'm wondering if you could talk more about what further progress would look like for consumers.
Well, 2% inflation down to 2% sustainably is what we're trying to achieve. We're somewhat above that, as you know, and we want to see serial readings that suggest that we're making further progress on inflation. That's what we want to see, and consumers will pick that up, of course, in the things that they buy at the grocery store or at the store.
The other thing I wanted to ask was just how far away you think you are from neutral.
Yeah, you can't know with any precision, of course. As I like to say, that you know the neutral rate by its works. So I think at 4.3%, we're above pretty much everyone on the committee's estimates of the longer run neutral. I think our eyes are telling us that our policy is having the effects on the economy. That's really the question we ask. You can consult models, empirical models, theoretical models. You really have to just look out the window and see how your policy rate is affecting the economy. And I think we see that it's having meaningful effects in bringing inflation under control. It has helped bring the labor market into balance as well. So that's what we think. I would say we're meaningfully above it. I have no illusion that anyone knows precisely how much that is. But not knowing that and having cut 100 basis points means that it's appropriate that we not be in a hurry to make further adjustments.
Victoria.
Victoria Guido with Politico. So as a general matter, when it comes to executive orders and OMB memos, do those always apply to the Fed, sometimes never, or do you just often voluntarily comply? What is the legality there?
So it's been our practice, as I mentioned, to work to align our policies to those that are mentioned in the executive orders, and I'm just going to leave it at that. As I mentioned, I'm not going to go any deeper than that or get into any deeper into this set of issues today.
Claire.
Claire Jones from the Financial Times. Two questions, if I may, on tariffs. Well, first of all, we've seen global trade wars before, notably in 2019, last time around, but then we were in a very different place on both inflation and growth. If we see tariffs of the same sort of magnitude that we got then, which I know is big if, what do you think might be different this time around? And secondly, Tiff Macklem said there was no doubt that the threat of tariffs was a big driver of the cut by the Bank of Canada today. What sort of information would the Fed need to see on tariffs before it was willing to take such a preemptive move? Thank you.
Sorry.
What sort of information would you need to see on tariffs? Would you need to see a strategy, actual implementation, actual movement of inflation expectations before you're actually willing to change the path of monetary policy on the basis of it?
Yeah, so first of all, things are a little different now. We've just come through a high inflation period, and you can argue that both ways. You can say that companies have figured out that they do like to raise prices, but we also hear a lot from companies these days that consumers have really had it with price increases. And so I don't know how that shakes out. Nonetheless, you're coming through a situation where we're not quite back to 2%, and that's just different. In addition, the trade, the kind of footprint of trade has changed a lot as trade is now spread around. It's not as concentrated in China as it was. There's a lot more manufacturing. It moved to Mexico and other places. So there are differences, and I just think the range of possibilities is very, very wide. We just don't know, and I don't want to start speculating, as tempting as it is, because we really don't know, and we didn't know, by the way, in 2018. We didn't really know, and the range of possibilities very, very wide. We don't know what's going to be tariffed. We don't know for how long or how much, what countries. We don't know about retaliation. We don't know how it's going to transmit through the economy to consumers. That really does remain to be seen. There are lots of places where that price increase from the tariff can show up between the manufacturer and the consumer. Just so many variables. So we're just going to have to wait and see. And the best we can do is what we've done, which is study up on this and look at historical experience, read the literature, and think about the factors that might matter. And then we'll just have to see how it goes.
Courtney.
Thank you. Courtney Brown from Axios. Two unrelated questions. The first is whether or not there was any discussion about QT and the timeline for ending QT at this meeting. And then the second question is just, I wonder if the AI prompted sell-off in the stock market this week signaled anything to you about the state of financial conditions?
So let's talk about runoff. So the most recent data do suggest that reserves are still abundant. reserves remain roughly as high as they were when runoff began, and the federal funds rate has been very steady within the target range. We track a bunch of metrics, and they do tend to point to reserves being abundant. We do intend to reduce the size of our balance sheet to a level that's consistent with implementing monetary policy efficiently and effectively in our ample reserves regime. We're closely monitoring a range of indicators to assess conditions, and that should provide signals whether reserves are approaching a level that could be judged as, quote, somewhat above ample. I don't have anything to say to you about particular dates. It's just that's the process, and what we see is that the rates do appear to be abundant. As always, we stand ready to take appropriate action to support that smooth transition of monetary policy, including to adjust the details of our approach for reducing the size of the balance sheet in light of economic and financial developments. On AI, it's a big event in the stock market and in particular parts of the stock market. I mean, what really matters for us is macro developments, and that means substantial changes in financial conditions that are persistent for a period of time. So I wouldn't put that label on these events, although, of course, we're all watching it with interest.
Simon Rabinovich with The Economist. Thank you. You mentioned in your remarks that activity in the housing sector seems to have stabilized. At the same time, since your first rate cut in September, long-term mortgage rates have gone up by a full percentage point, back above 7%. I'm wondering, kind of looking forward, are you confident that activity will remain stable given how elevated mortgage rates are? How does it fit into your broader thinking about the economy?
So, as you know, as we've reduced our policy rate 100 basis points, longer rates have gone up, not because of expectations, not principally because of expectations about our policy or about inflation. It's more a term premium story. So, and it's long rates that matter for housing. So, I don't think I think these higher rates are going to they're probably hold back housing activity to some extent if they're persistent. We'll have to see how long they persist. So, we control an overnight rate. Generally, it propagates through the whole family of asset prices, including interest rates. But in this particular case, it's all happened at a time when, for reasons unrelated to our policy, longer rates have moved up.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you want to see further progress on inflation. Given that households appear to be unhappy with the elevated level of prices, do you believe the committee should wait until inflation has fallen back to target to cut rates again?
No, I wouldn't say that. We've never said we need to be all the way at target to reduce rates. At any time, what we're doing is we're looking at the economy and asking whether our policy stance is the right one to achieve maximum employment and price stability. So I think if we would want to see further progress, but we think our, as I mentioned, we think that our policy stance is restrictive, meaningfully restrictive, not highly restrictive, but meaningfully restrictive. And so I would think we need to see further progress. I wouldn't say all the way back down to 2% on a sustainable basis. Although we'd love to see that, of course, and we will.
And separate question for you on tariffs. Curious whether the threat of tariffs and not knowing whether they could stick or not creates uncertainty for business here in the United States and could cause them to pull back, ultimately weighing on growth. Does the threat of tariffs cause you to ponder your growth forecast?
I want to avoid commenting even indirectly on the conduct of tariffs. It's not our job, and it's not our job to comment on the moves that people make. So I wouldn't want to criticize anything that's happening or really comment on it one way or another, praise it for that matter. It's just not our job. I do think that, we found in 2018, there was a lot of work done on trade policy uncertainty. Trade policy uncertainty, if it's large and persistent, can start to matter for businesses making investment decisions and things like that. That's not something I'm observing today. It's very early days for this, but I think that did matter in 2018-19, and it's one of many things we'll be watching.
Matt Egan.
Thank you, Chair Powell. Matt Egan from CNN. Following up on Courtney's question from earlier about the stock market,
How concerned are you, if at all, about potential asset bubble brewing in financial markets? How do relatively high market valuations factor into considerations about potentially lowering interest rates further? Is that something that's in the back of your mind?
So we look from a financial stability perspective at asset prices generally, along with things like leverage in the household sector, leverage in the banking system, funding risk for banks and things like that. But it's just one of the four things asset prices are. And yeah, I'd say they're elevated by many metrics right now. A good part of that, of course, is this thing around tech and AI. But we look at that. But we look at how resilient the households and businesses and the financial sector are to those things. So we look at that mainly from a financial stability perspective, and we think that there's a lot of resilience out there. Banks have high capital, and households are actually overall, not all households, but in the aggregate, households are in pretty good shape financially these days. So that's how we think about that. We look at overall financial conditions, and you can't just take equity prices. You've got to look at rates too, and that represents a tightening in conditions with higher rates. So overall, financial conditions are probably still somewhat accommodative, but it's a mixed bag.
Hi, Chair Powell. I'm Richard Escobedo with CBS News. One question for you. This month's statement notes that unemployment has stabilized at a low rate and that the labor market is solid. You walked through some of what's driving this, but I wonder what risks you see that might challenge your assessment.
Well, the things we discussed earlier, one is that there's a low hiring rate. And so that if there were to be a spike in layoffs, if companies were to start to reduce headcount, you would see unemployment go up pretty quickly because the hiring rate is quite low. So that's one thing we look at. I think it's worth pointing out that for lower income households, they're under significant pressure. And in the aggregate, the numbers are good, but we know that people at the lower end of the income spectrum are struggling with costs. And really, it's high inflation for the basics of life. It's not so much the inflation now, it's the price level, because inflation has raised prices. Inflation is now much closer to target, but people are really feeling that. But overall, this is a good labor market. You're at 4.1% unemployment. That's just a really good level, and you've been solidly there now for 6-7 months. And job creation is pretty close to a level that will hold the unemployment rate there, given that there'll be much slower population growth.
One more question. Some of the uncertainty around immigration policy is, in your assessment, is that making it harder for businesses and the Fed to plan going forward?
We hear anecdotal reports, but I don't see there's nothing in the data yet on that. But you hear that kind of thing about construction, for example, and businesses that are dependent on immigrant labor are saying that it's suddenly gotten harder to get people. But I know you don't see that in the aggregate data yet, but yes, you hear it anecdotally.
Nick.
Thank you, Chair Powell. Nicholas Jasinski from Barron's. The uncertainty is certainly a theme today, and I'm wondering, are there any periods from your career, or as it relates to markets, the economy, what's going on here in Washington and beyond, or from lessons from history that may provide some guidance for a central banker operating in uncertain times like today?
I guess I'd say this. Uncertainty is with us all the time. It is human nature, apparently, to underestimate how fat the tails are in a way. The possibility, we think of things in a normal distribution, and in the economy, it's not a normal distribution. The tails are very fat. That was uncertainty. Are we going to be able to reopen the economy? If so, when? But how long will it take? that was uncertainty. What we have now is a good labor market. We have the economy growing at 2 to 2.5%. Inflation's come down to now the headline inflation number was 2.6, and that's what the public experiences. We look at core because it's a better indicator of future inflation. So yes, the price level went up a lot for inflation, and people are feeling that, and they're not wrong. But so the kind of uncertainty we have is just a usual level of uncertainty about the economy, but then policies which are not for us to criticize or praise, really. Those are policies which people have been elected to implement. They're implementing them with a view to making a better economy. And so I don't think I wouldn't call this out as one of those times. I wouldn't compare it to the global financial crisis or anything like that, given that we things we'll know it when we see it, but more the expectation is that we will make continued progress, and that's what we want. We'll know it when we see it. It's going to have to be something that isn't just idiosyncratic. You're going to want to see continued progress with housing services inflation. You're going to want to see inflation behaving in a way that builds confidence that we are really making progress. That's what it's going to be. And I mean, is that better than our expectations? We expect to see that. It's just a question of when.
Hi, Chair Powell, Scott Horsley from NPR. In your 5-year review, you said the 2% inflation target won't be on the table. Can you talk a little bit about why? Is that because you think that's the right target, or is it because you don't want to move the goalpost mid-game, or what's behind that?
I think that goal has served us well over a long period of time. It's also the sort of global standard. I think that if central bank wanted to look at changing that, you wouldn't do it at a time when you're not meeting it anyway. I would not look at changing it anyway, but I certainly wouldn't look at it at a time when you're not meeting it. I mean, there's just no interest at all. Unclear. We're not going to change the inflation goal anytime soon.
And 5 years ago, if I can paraphrase what y'all decided, it was you're going to not raise interest rates preemptively to head off inflation until you see sort of the whites of the eyes of inflation, because the solid labor market was so beneficial. Have the last few years changed your thinking about that?
So what we really said was that we wouldn't look at a strong labor market and raise rates unless we saw some evidence of inflation. So the thought was that we'd seen really low levels of of unemployment with no sign of inflation. So why would you preemptively want to put people out of work in the absence of any kind of any evidence that suggested that this was not a sustainable level? It was a way of acknowledging how much humility we have about the starred variables, especially U-star, the natural rate of unemployment. So that was an insight. We'll discuss that again. That'll be one of the many things that we discuss. But I don't think that insight is wrong. We didn't, we said what we said was that at times when inflation persistently undershot 2%, we would likely allow inflation to run moderately above 2% for some time. That's what we said. That turned out not to be relevant to what actually happened. There was nothing moderate about the overshoot. it was an exogenous event. It was the pandemic, and it happened. And our framework permitted us to act quite vigorously, and we did once we decided that that's what we should do. The framework had really nothing to do with the decision to. We looked at the inflation as transitory, and right up to the point where the data turned against that. And when the data turned against that in late 21, we changed our view and we raised rates a lot. And here we are at 4.1% unemployment and inflation way down. But the framework was more irrelevant than anything else. That part of it was irrelevant. The rest of the framework worked just fine as we used it, as it supported what we did to bring inflation down.
Let's go to Mark for the last question.
Hello, Chairman Powell. Mark Hamrick with Bankrate. As you know, in the annual report from the Financial Stability Oversight Council, among the risks outlined is cryptocurrency. Could you talk about those risks now? And regarding individuals and households, perhaps distinct from the concern about the financial system, do you worry that speculation in this unregulated asset class could hurt their financial well-being, or do you think it has a place in a household's portfolio?
So our role with Bitcoin really is to look at, with crypto, really is to look at the banks, and we think it's, banks are perfectly able to serve crypto customers as long as they understand and can manage the risks, and it's safe and soundness. A good number of our banks that we regulate and supervise do that. The threshold has been a little higher for banks engaging in crypto activities. And that's because they're so new, and we don't want to make the mistake. If you're making a choice to conduct that activity inside a bank, which is inside the federal safety net with deposit insurance, then you want to be pretty sure that it's a safe and sound activity. So, we're not against innovation, and we certainly don't want to take actions that would cause banks to terminate customers who are perfectly legal, just because of excess risk aversion may be related to regulation and supervision. So,
and with respect to households and their inclusion in that asset class,
that's kind of it's not really our bailiwick. You want people to be knowledgeable about the financial engagements that they have, and that's why we have the securities laws that we have. It's why if you read a mutual fund prospectus or individual stock prospectus, you want households to have the chance to understand the risk that they're taking. And I do think it would be helpful if there were a greater regulatory apparatus around crypto, and I think that's something Congress was working on quite a lot. We've actually spent a lot of time with members of Congress working together with them on various things, and I think that would be a very constructive thing for Congress to do. Thank you.